Hello students, welcome back. This is Dr. Mercado. Welcome to another lecture for Accounting 1303, Introduction to Accounting 1. In this lecture, we are going to be covering content from Chapter 6, which is the financial statements and the closing process. The specific problem that I'm going to be covering in this lecture is problem 6-7A, which will be on your upcoming exam. Okay, now before I begin with this week's lecture, it is important that I remind all of you to please read the chapter. The chapter contains important information, examples that will help you in completing your assignments. Do not skip that part, please. Okay, so let's begin. This problem is going to be the preparation of the three financial statements, the income statement, the statement of owner's equity, and the balance sheet. I am going to run through it slowly and carefully with you. That way you comprehend how to complete the process. Learning how to prepare financial statements is a critical component in the accounting cycle process. Okay, so let's quickly begin by going over some of the information provided to you in the ebook. This is coming straight from the ebook. Okay, now we are going to be preparing the financial statements using a worksheet. Okay, so the worksheet has been completed and we have it done, and now using that information we are going to be completing the financial statements. Okay, so basically the income statement, we already know this because we've been covering financial statements from chapter 1. The income statement is your revenues less your expenses, gives you your net income. If your revenues are greater than your expenses, then you've got income. If your expenses are greater than your revenues, then you've got a loss. So now on the textbook, it's saying that we're going to prepare the income statement by looking at the income statement columns of the worksheet. That information is provided, and you basically just bring in your revenue accounts and your expense accounts and then do the calculation for your net income or net loss. Okay. Now the statement of owner's equity, that is also prepared with the use of the worksheet, and as you can see here, these are the balance sheet columns of the worksheet. The information for both the statement of owner's equity and the balance sheet is coming from the worksheet, the balance sheet columns. Okay, so you're basically just feeding in the data from the worksheet over to the financial statements. Now it does say here that be careful when using the capital account balance reported on the worksheet. This account balance is the beginning balance plus any investments made during the period. Okay, so you need to look at, whenever you're looking at your worksheet, look at the beginning balance of your capital account and look at the ending. If it changed, that means that you had investments during the period, which is the difference. If it stays the same, then basically that means that that's the original investment that you started off with. So you just need to be careful with that. Look at the capital account and see if it changed from the unadjusted to the adjusted numbers, and make sure that it hasn't changed. If it changed, that means that an investment has been made, and usually that information is provided to you in the problem. An additional investment of X dollar was made during December, January, whatever the case might be. Okay. If it's a brand new business, you're going to start off with zero capital. Then you have your investment during the month, which is the case here. It was a brand new business. We started off with zero. We invested during June, 15,000. Then the total investment will be 15,000. Now, assuming the next month there is no investments, your starting balance will be the 15,000. You will have no investments, but you will still end up with the 15,000. Okay, so it's just a matter of where you locate the information. The net income is also provided at the end of your worksheet. That also feeds into your statement of owner's equity. The withdrawals are listed in your worksheet under the balance sheet columns. So it's just basically a transfer of information from your worksheet to the financial statements. Okay. Now on the balance sheet, there are some major changes happening. Okay. So there's two important features of the balance sheet. First, it is a report form. We are transitioning from the left and the right hand side to the report form of the balance sheet. This basically just lists all of the information. As you can see here downwards, we have our assets, our liabilities, and our equities. The purpose continues to be the same, which is to make sure that our assets equal our liabilities and owner's equity. That has not changed. Your total assets need to equal your total liability and owner's equity. It's just the format has changed a little bit. Okay. and another thing in this particular balance sheet is the classification of accounts. We are grouping information together. So we have a section called current assets. If you see here, we've got current assets. And what is a current asset? Okay, basically a current asset includes cash and assets that will or can be converted into cash or consumed within 1 year or 1 year or the normal operating cycle of a business, whichever is longer. And the common examples include cash, accounts receivable, supplies, and prepaid. Okay, so on the top section, we're going to break out the balance sheet between current assets and property, plant, and equipment. Current assets are anything that will be used or converted to cash within 1 year term. Property, plant, and equipment, those are your long-term assets. These are the assets that you're going to have for longer than one period. And this includes your vehicles, your land. This includes your buildings, your furniture, anything of that nature. So if it's going to last you longer than a year, it goes under property, plant, and equipment. So let me see what they put here for property, plant, and equipment. So these are known as planned assets or long-term assets, and they basically represent assets that are expected to serve the business for many years, and they have land, buildings, and equipment as examples. Okay, now that's the only change. Before we just had our total assets. Now we're splitting the assets into two: current assets and property, plant, and equipment. Current assets are anything that is cash or can be converted to cash or will be used up within a term of a year or less. Property, plant, and equipment are your long-term assets, anything that will serve you for longer periods of time. Okay. On the liability section, we also have two classifications: current liabilities and long-term liabilities. In this example, we only have current liabilities, but let's see what we have here. Okay. Current liabilities are anything that is due within 1 year. If you owe it and it has to be paid within a year, that is a current liability. Okay. This includes accounts payables and salaries or wages payable. They're classified as current liabilities because you should expect to pay out these in a short period of time. Now, long-term liabilities or long-term debt, these are obligations that are not expected to be paid within a year. A mortgage on an office building is an example of a long-term liability. Maybe you buy a car and you're going to pay it in a 6-year term. That is a long-term liability. You owe the money at a fixed installments for the next 6 months. Okay, so it's just a matter of classifying. Current is anything that is due within a year. Long-term is anything longer than a year. Okay, so those are two of the key changes in our balance sheet, but the concept remains the same. We are to balance our total assets to our total liabilities and owner's equity. Okay, the textbook does a great job in providing you with examples of each. Please make sure that you review the information carefully. Okay, so now let's jump up to the actual problem. Okay, we're going to be preparing the 3 financial statements. So it says, refer to the following worksheet for Perez repairs. No additional investments were made by the owner during the month. So this is an established business. It's already been in business for a couple of years or whatever. So they're just letting you know what, this month there was no additional investments, and that comes into play when we are preparing our statement of owner's equity. Okay, so there's no additional investments. We have received notification of that. Now we are provided with the data. They're asking us to prepare an income statement, a statement of owner's equity, and a balance sheet. The financial statements need to be prepared in that specific order. The income statement goes first, the statement of owner's equity goes second, and the balance sheet goes third. Okay, so let's begin with the income statement. The income statement is the easiest of them all. It is just your revenues minus your expenses. Okay, so we're going to start off with the revenues. We're going to go ahead and we're going to locate. Now, if you look at the worksheet, we're going to focus on right now on the income statement column. Okay, we're going to focus on the income statement column. Okay, so the data is coming from here, from the income statement. So we should be looking at these numbers. Now, according to the problem, we only have one revenue account, which is your repair fees. Okay, so we have one account, which is repair fees. And we have $4,700 because we only have one. I'm going to take it to the very end. Remember, if you have multiple accounts that you need to add, you bring them to the first column, add them together, and take the total to the second column. On the second column, you should only have the grand totals, okay? So we only have one revenue account. We brought it in, repair fees, okay? So we have it right there. It's been used, okay? Now, below that, you're going to have all of your expense accounts, okay? So they have a normal balance of a debit. You're going to just copy that information over to your income statement. So we're going to start off with salaries and wages expense, okay? And remember, you are picking up the numbers from the income statement columns of your worksheet, okay? So we've got $21.50 for the salaries and wages expense. We have advertising expense. My advertising is $200, okay? And you just bring them in the same order that you have them on your worksheet, okay? Then we have rent expense. My rent expense is $640, okay? And then we have supplies expense. My supplies expense is $300, okay? And then we have phone expense. My phone expense is $50. I've got my insurance expense. My insurance expense is $230. Then we have gas and oil expense. My gas and oil is $200. Okay. We've got depreciation expense. And this is for the delivery equipment. And that is $55. Okay. And we've got miscellaneous expense at the very end, $37. Okay. So that is my list of all of the accounts. I am just bringing them in from down here. So I am bringing in all of my expenses from down here. Okay, all I do is I copy and I paste these numbers over to your income statement. Okay, so these are your expenses, and we also bring in your revenues as well. All of these numbers have to be used up. Okay, so you have your revenue of $4,700 and you have all of your expenses. Okay, now that I've got that, I can calculate my total expenses. Okay, so I'm going to add up. I'm going to do the sum of all of these numbers. Okay, and because I'm using Excel, it's much easier. Okay, I've got 3,862. So then you ask yourself, okay, I've got revenues of 4,700. I've got expenses of 3,862. The 4,700 is the money that you generated out of your repair fees. Okay, the 3,862 repair that is basically the cost associated with running your business. You had to spend $3,862 to be able to generate your fees. Okay, so then you ask yourself, which number is higher, your revenue or your expenses? In this case, my revenues are higher, so that means I have net income. If your revenues are greater than your expenses, then you have income. Okay, so to calculate your income, you're going to get your revenues minus your expenses. Okay, and that's going to give you your net income of $838. Okay? Now, if your expenses would have been greater than your revenues, then you would have had a net loss. And it does happen, especially when you're starting off a new business, you will have losses at the beginning. Okay, so that is the income statement. Very simple. Your revenues minus your expenses will give you your net income. Okay, so we have completed the first financial statement. Now we're going to go to the next financial statement, which is your statement of owner's equity. Okay, now for the statement of owner's equity, we're going to start off with Don Perez Capital. January 1st, 20. Okay, so let's look at the capital account. Okay, this is where I mean that we need to look. We're going to look at the capital account, which is right here. Okay, let's see. Okay, so we're looking at the capital account. Okay, our beginning balance was 8,000. Okay, we did not have any adjustments. Okay, our adjusted balance is 8,000 and our ending balance is 8,000. So we started off with 8,000 in capital and we ended up with 8,000 in capital. That means that there was no investments made this month. Okay. In addition, the problem tells you no additional investments were made. Okay. So that means that before this month, I already had 8,000 capital. I'm just going to bring that over. Okay. So I had 8,000 capital. Okay. Now, what you can do is the next line item should be investments during the month. Now, you can include it or you can just skip it because we don't have any investments during the month, okay? This particular month, we don't have any investments, okay? So you can either include it and then you can do total capital for January, okay? It will be 8,000. I'm going to show you how to do it both ways, okay? Sorry about that. I put it in the wrong one. It should be right there. Okay. So we start off with the capital of 8,000. There's no investments during the month. So my total capital at the end of January, okay, is 8,000. Okay. Well, my total investments, not capital, my total investments. Okay. So it's 8,000. Now, from there, we're going to bring in our net income. Okay. Now, our net income, let me delete this. Okay. Okay, so my net income is going to come from your income statement. Okay, so the net income is going to flow there. So how much did I have in net income? I had $838. Okay, so I'm going to bring that number down here to my net income. Okay, now that is how much the business generated. Now we're going to deduct less withdrawals for January. Where am I going to get my withdrawals from? Well, we're going to look at our worksheet. Okay, and let's locate the drawing. Okay, so we have right below capital, we have the drawing. Okay, so this particular month we had a drawing of $1,100. Okay, so the owner withdrew $1,100 from the business. Okay, $1,100. So we're going to go ahead and we're going to put the $1,100 here. Okay, so we made $838 in income. The owner took out $1,100. They took out more than what we generated. Okay, so that means that my capital is going to decrease in capital. Okay, my capital is going to decrease by how much? Well, I'm going to do the 838 minus the 1,100. That's going to mean that my capital decreased by $262. Okay. Okay. Negative, because it's a decrease in capital. I spent or I took out more money than what I had generated. Okay. So now I can calculate my ending capital. Okay. So my ending capital will now be your $8,000 that you started off with minus, well, in this case it's add because it's a plus sign, minus your 262. Okay, so you subtract. Let me get the calculator because obviously in Excel it's a little bit different. I'm going to get my $8,000 that I started off with in capital. I'm going to subtract my decrease in capital of 262. That will give me my new capital of $7,738. So my capital balance decreased because of that withdrawal that I did. I didn't generate enough money, and the owner pulled out more money than what was generated during the month. Okay, so that's my new capital amount, $7,738. Okay, so that is the statement of owner's equity. Now you can do it like that, or let me just quickly copy and paste. Or if you want to completely get rid of this section, you can do that as well. You can just go like this. You're going to start off with your capital. You're going to bring in your net income. You're going to subtract your withdrawals. And then this is going to be, okay. does the same thing. It gives you the same information. It's just that in the top one, we made it clear that there was no investments during the month. In the bottom section, we're going to let the readers assume that they know that if a line item is not included, that means no investments were made. But either or is the correct way of doing it, and it yields the same answer. Okay? So that is the second requirement, the statement of owner's equity. Now we're going to do the balance sheet. Let me hide these so I can move this over. Okay? Now on the balance sheet, we are going to be looking at the balance sheet columns right here. They're labeled. Okay? So we're going to go ahead and we're going to do that. So now we're shifting to the balance sheet. On the income statement, all of the numbers have been used. Now we're looking at the balance sheet. So on the balance sheet, I have to bring in my assets. And remember, the worksheet is already ordered. We have our assets, then we have our liabilities, then we have our owner's equity account, then we have our revenues, and then we have our expenses. That is the order that they are in. Okay, so now for the balance sheet, we're going to start off with the new concept that we have, which is our current assets. Remember, our current assets are anything that is cash, can be converted to cash, or will be used up within a year or less. Okay, so we're going to bring in our accounts that are current assets. Okay, that would be our cash. We have 3673 in cash. Okay, that would be our accounts receivable. Okay, we've got 1450 in receivable. We've got supplies of 400. Okay, we've got prepaid insurance. Okay, of 670. Okay, now the next asset that we have is delivery equipment. So you have to ask yourself, is this equipment going to last me longer than a year? And usually the answer is yes. Usually equipment lasts longer than a year. So that means that is not a current asset. That will go under property, plant, and equipment. So these are the only current assets that I have. I'm going to get my total current assets. Okay. And I'm going to add them up. So my total current assets are 6193. Okay. Now I'm going to have my property, plant, and equipment. These are your long-term assets. So if we look at the list, we're going to have delivery equipment. Okay. And we have the accumulated depreciation associated with it. Okay, so we're going to start off with delivery equipment. My delivery equipment is 3200. Okay. I have less my accumulated depreciation for the delivery equipment. Okay, that is my accumulated depreciation is $55. Okay, so we're gonna get our total property, plant, and equipment. I'm gonna abbreviate PPE is property, plant, and equipment. So I'm abbreviating property, plant, and equipment is PPE. So my PPE is going to be your cost of your asset, which is 3,200 less minus the accumulated depreciation. So that's going to give me total property, plant, and equipment of 3,145. Now I can calculate my total assets. Okay, your total assets will be your total current assets plus your total property, plant, and equipment. Okay, that gives you 9338. That is the total of your assets, but it's now broken down between current assets and property, plant, and equipment. Okay, and these are the totals for each, with my total assets being 9,338. Next, we're going to continue looking at our worksheet, and we're going to look at our payables. And we have accounts payable and salaries and wages payable. Remember, liabilities are anything that we owe. This is our debt. So we're going to start off with our accounts payable. For accounts payable, I've got 1,200. Okay. Then I'm going to have my salaries and wages payable. and I've got 400. Okay, so that's going to give me my total current liabilities. Okay, now I forgot to label this. Let me copy and I'm going to paste it down. Okay, now we need to ask ourselves, what kind of liabilities are there? Remember, we have two types of liabilities. Okay, we have current liabilities and long-term liabilities. Are those current or long-term? Well, we said if they were going to be paid in a year or less, and the examples are accounts payable and salaries payable, which is what we have, they are current liabilities. These are liabilities we're going to pay in a year or less. Our long-term liabilities are those that it's going to take us longer than a year to pay. So let's go back and let me label my liabilities as current liabilities. Okay, that way we know what kind of liabilities are they. They are current liabilities, and I misspelled liabilities. Okay, there we go. Okay, so my total current liabilities, we're going to add those two together, and that's going to give me 1,600. Okay, that is my total current liabilities. Okay, now we're going to do the owner's equity section. Now this is where students always have problems. Okay, we're going to bring in Don Perez capital. But we are not going to get the capital amount from the worksheet. No, we're not. That is not correct. We're going to get the capital. Okay, we're going to get the capital. Let me unhide this. We're going to get the capital from our statement of owner's equity. Okay, so we're going to go ahead and we're going to take that capital up here. Okay, so the capital amount that we are going to put in our owner's equity section is coming from our statement of owner's equity. Okay, either of the numbers is fine. Okay, let me just do this one, it's shorter. Okay, so the 7738 is going to be your capital. Okay, we only have one capital entry, so it'll be at the end. Okay, so now that we've brought in, remember the capital amount does not come from the worksheet. It comes from your statement of owner's equity. Okay, the ending capital is what you feed into your balance sheet. Okay, now that we've done that, I can calculate my total liabilities and owner's equity. Okay. So I'm going to go ahead and I'm going to add my liabilities of 1,600 plus my capital account of 7,738, and that gives me total liabilities and owner's equity of 9,338. Okay. Now remember, the whole point of the balance sheet is to balance. Your total assets need to equal your total liabilities and owner's equity. If you are not in balance, you made a mistake, we need to go figure out where you made your error so you can fix it. Okay, so remember, on the worksheet, the columns for income statement and balance sheet are referenced. That is what you're going to be using to prepare your financial statements. Okay, so this is the last financial report that we have. It's in balance, so we are good to go. Okay, so now we've completed both the income statement, the statement of owner's equity, and the balance sheet, all completed from beginning to end. And we have been practicing financial statements for a while, so this should be easy. The only changes are on the balance sheet, where now it's in a report form, and we have our classifications between current assets, property, plant, and equipment, current liabilities, and long-term liabilities. Okay, so make sure that you do read your ebook, you complete your weekly assignments. Remember, 2 attempts are provided and the highest grade is kept. Okay, the more you practice, the better that you're going to get at it. Okay, please review your syllabus and ensure you keep up with all assignment deadlines. And until next time, have a wonderful rest of your week. Bye-bye.